Welcome back, everyone. Let's go ahead and take a look at this example. And this one says a medium-sized profitable corporation may buy a $15,000 used pickup truck for use by shipping and receiving department. During the truck's 5-year useful life, it is estimated the firm will save $4,000 per year after all costs of owning and operating the truck have been paid. So that is the net saving that they get per year because they bought that truck, and the cost of that truck was $15,000. Truck salvage value is estimated at $4,500, so that this can be solved using an equation or annuity function rather than a full spreadsheet. Assume the straight line depreciation method is used. What is, part A, what is the before tax rate of return? And in part B says, what is the after-tax rate of return on this capital expenditure, assuming straight line depreciation? Well, the depreciation will be applied on this cost basis, and that is $15,000. And that will be spread over 5 years of the life. And the salvage value is $4,500. So let's go ahead and get started and establish the before tax cash flow, and then step by step we get to the after tax cash flow. And I want to do that in a tabular format. So I'm going to draw a table here. And first column would be year, and we have 5 years. And the second column would be before tax cash flow, and I'm going to indicate that with BTCF. And the before tax cash flow in this case is in year 0, they're buying the asset for $15,000, so that's a negative $15,000 at year 0. And for year 1 through 5, they're going to save $4,000. Also, at year 5, they're going to salvage the pickup truck for $4,500. So there's going to be another $4,500 at year 5 as well. So year 5 is going to have both of those two. And then in the next step, I'm going to calculate the depreciation. And I'm going to call that column depreciation. And depreciation, to calculate that using the straight line method, we know that that is cost basis minus salvage value over the useful life, and that is $15,000 minus $4,500 divided by 5. And when you calculate that, that is $2,100. So that is the depreciation that is going to be claimed for 5 years. So I'm going to write that down here, $2,100 for 5 years. Now that we have the before tax cash flow, we have the depreciation. We can deduct the depreciation from the before tax cash flow, and that will be taxable income. So I'm going to call taxable income TI, and we can calculate that by subtracting the 2,100 from 4,000, which will leave us with 1,900. So 1,900 is their taxable income for these 5 years. Note that this salvage value is not taxable. So we're not going to include that in the tax calculation. We're just going to use the 4,000 minus 2,100, that is 1,900. The $4,500 that is going to be remained untouched with tax purposes. Now that we know the taxable income, it's time to apply the tax rate on that and calculate the income tax rate, and that is IT here. In this column, well, at this point, we got to know the tax rate. And tax rate is not directly given to us, but what we're going to assume is that the medium-sized profitable corporation, we're going to assume that this is in this category of mid-size corporation, and 34% is the incremental tax rate in this case. And if that is 34%, 34% of $1,900 will be the amount of tax that they need to pay. So 34% times 1900 is 646. You can do the math. Now at this point, we know the amount of tax that they need to pay. If we subtract the tax from the before tax cash flow, we get to the after tax cash flow. So that's what I'm going to do here. The last column would be after tax cash flow, or ATCF, and that will be 4,000 minus 646. Remember that in year 0 we have the negative 15,000, but starting from year 1 all the way to year 5, we're going to have after tax cash flow of 3,354. Remember that we didn't touch the salvage value, and that salvage value will directly come here to the after-tax cash flow. Now, we know the before-tax cash flow, we know the after-tax cash flow. We can calculate the rate of return of them either manually or using Excel. If you're using Excel, you can either use the IRR function or use the rate function to calculate the rate of return for this column, after-tax cash flow, and for before-tax cash flow. The IRR function will just need the values that you're going to use. In that case, you can grab or take all the values in these two columns and pass it in to the IRR function. That will calculate the rate of return for you. Or a more difficult way of calculating the rate of return is using the rate function. And rate function will need some more information. One of them is number of periods. And number of periods here is 5. And then you need to pass in the PMT, and that is a uniform return that you're receiving every year, and that is 3,354 for the after-tax cash flow. For before-tax cash flow is 4,000. You need to pass in the present value. Present value in both cases is negative 15,000. And last thing is you need to pass in the future value. And future value in both cases is $4,500. So using those two functions in Excel, you can calculate the rate of return for after-tax cash flow and before-tax cash flow. Or if you're going to use the manual calculation, you will have to calculate the present worth of each cash flow and set it equal to 0 and solve it for I, or the interest rate. For the before-tax cash flow, that is negative 15,000 plus 4,000 times P given A, some I star in 5 years, plus 4,500 times P given F, I star 5 years. And when you set that equal to 0 and solve for I, you can use interpolation here, and if you try two different percentages, let's say 15%, and if you try also 18%, you will see that the IRR is between those two values, and if you do the interpolation, you will get IRR of 16.7%. And that is IRR of before tax cash flow. And you need to do the same calculation for after tax cash flow. Set the present worth of after tax cash flow equal to 0 and do the same calculation. You will get a different IRR, and obviously that IRR is going to be smaller. In fact, that is 11.15%. And the reason that we are reducing the IRR is that you had to pay taxes, and that will reduce your return over the years, and your IRR goes down. So to summarize the process of calculating after-tax cash flow, you start with before-tax cash flow. You calculate the depreciation using any of the methods that you want. For tax purposes, the only legal method is MACRS. And once you calculate depreciation, you subtract it from before tax cash flow, and that will give you the taxable income. Using the tax rate, incremental tax rate, and multiplying it to the taxable income, you get the income taxes. Once you have the income taxes, you subtract it from the before tax cash flow, right? And that will give you the after tax cash flow. And after tax cash flow is a more realistic representation of an investment problem. And then you can calculate net present value, rate of return, payback period, or other performance measures on that cash flow.